We have discussed in our previous video about fundamental financial statements which include balance sheet, income statement and cash flow statement. We had discussed in detail about the balance sheet, its line items and income statement, and broadly about the cash flow statement. The link for the video will be provided in the description box below. Now we shall discuss in detail about the cash flow statement. We will start our journey of understanding cash flow statement by developing a business model of how the cash flows in a simple business work. We will then develop our knowledge of cash flows by incrementally adding complexity to this model. Let's take the example of a simple business model of an antique dealer who buys and sells old jewelry. The aim of a business is to maximize wealth, in other words, maximize future cash flows of the business. So the cash flow of her business will look like this. Using cash, the trader purchases goods which she holds as an inventory. Later, she resells the goods which are acquired for more than the amount paid for them, receiving cash. She will also incur cost of transport and cost of communication to sell her goods, which is also referred to as overheads. Based on her previous knowledge of being a trader in antique jewelry, Priya is now wanting to start a manufacturing unit for making jewelry. Her cash flow model of the manufacturing unit will look like this. Using cash, she makes a purchase of raw material and does work on them, so converting raw material to work in progress and eventually finished good. She then sells the finished good in exchange for cash. In the process of conversion of raw material to finished goods, she will incur overheads such as manufacturing cost and other selling cost. Priya cannot manage her manufacturing unit all by herself. She needs people to help her and machinery to optimize the process. So to her cash flow cycle, labor gets added as an overhead as it is consumed by the business to add value to the raw materials. Then as she purchases a machinery, fixed assets will also get added to the cash flow cycle of the business. As a next step for her business growth, Priya sells her manufacturing unit to a well-established jewelry making company, XYZ Private Limited. The business is now owned by a company. The owner's interest in the company is the equity and they are the shareholders of the company. Apart from equity, company may also have raised cash to invest in the company by borrowings from banks. This can be used by the company to purchase fixed assets or for all other activities of the business. So now the cash flow cycle will have inflows of cash from equity and debt. However, they do not come without cost. Shareholders need dividends on their amount invested in the company. Similarly, for amount borrowed from banks, the company will have to pay bank interest. The company also has to incur tax payments on the surplus generated by the company. So, is the cash flow cycle complete now? The answer is no. This is because when the company purchases raw materials in bulk quantities, it will not be paid immediately to the suppliers. In the same way, when the company sells goods to their customers, they will not collect cash immediately from the customer. So, there is a time factor which is involved in making payments on purchases and receiving cash from sales. So, this creates a creditor or accounts payable and debtors or accounts receivable in our cash flow cycle. Now, the cash flow cycle of the company will look like this. Creditors will grant the company a short-term interest-free loan while the liability remains unpaid. Similarly, debtors of the company will also be provided with a short-term loan to settle their cash for goods received. Time delays are essential to the cash flow model and should be incorporated. So now the cash flow cycle of the business also includes debtors and creditors. So we can summarize that business will order goods and services from its suppliers. Once it is delivered by the suppliers, it creates a creditor or accounts payable. Raw material, labor and other overheads will be consumed and converted to work in progress and finished goods. Then debtor is created for amounts to be received from the customers, and once cash is received from debtors, the creditors will be paid. This movement of cash and resources is the working capital cycle. In order to generate cash, the business must go round the working capital cycle at least once. So every time the business completes a circuit, more cash is generated. The more quickly the business can move in the cycle, the more quickly it can generate cash. We have now understood how a complete cash flow cycle for a business will look like. We can divide the cash flow cycle into three main categories. All the cash inflows and outflows that relate to purchase of raw materials, conversion of raw material into work in progress and finished goods, and sale to the customers and payment of creditors can be categorized as cash flow from operating activities. All the cash flows and inflows that relate to investing activities such as purchase or sale of fixed assets can be categorized as cash flow from investing activities. All the activities that relate to financing the business either in the form of equity or borrowings from banks which is in the form of debt, payment of dividends or payment of interest can be categorized as cash flow from financing activities. These are the three major categories which the companies use to present their cash flow statement. We can also relate these three categories in the cash flow statement of Facebook's annual report, which we have discussed in the previous video. Now let's get into the details of how cash flow from these three categories are computed by the companies. The cash flow statement is generally prepared using two methods, either the direct or indirect method. The direct method of preparation will be discussed later in the video because most companies prefer using the indirect method of computation. So let's take the first category under indirect method, which is cash flow from operating activities. To arrive at cash flow from operating activities, the net income is taken from the income statement. To the net income, non-cash expenses such as depreciation will be added back to eliminate non-cash expenses, and also other income such as investment income or interest income that does not relate to the operating activities of the business will also be added back. So this gives the operating income or operating profits for the company. To the operating profits or incomes of the company, any changes in working capital should be added or reduced depending on the movement in net working capital assets. So, by doing this computation, companies will arrive at the cash flows that they have from operating activities of the business. But what is meant by changes in net working capital assets? To understand that, we need to first understand what working capital is. We have to invest cash in raw material, work in progress, and finished goods to produce the goods. We also have to invest cash to lend to our customers until they pay. However, on the other side, we also get interest-free loan from our suppliers or creditors. So, the difference between the amount we expect to receive from the debtors minus the amount that we expect to pay to the creditors is the working capital available to the company. So, working capital measures how well a company can sell its current assets, for example, inventory, to pay its current liability or accounts payable. To know more about the definition of current asset and current liabilities, please refer to my previous video. Let's take an example. If accounts payable is due in 30 days, then company should be able to sell some of the inventory to pay to the supplier. If the company did not have enough inventory or cash, it would be difficult for the company to pay to its supplier. So, working capital is a measure of how well the debt can be managed by the company, and it also is a measure of how well the company can manage the day-to-day operating expenses of the company. A company that has an excess of current asset to meet the current liability has a positive working capital. Generally, companies should maintain a positive working capital because it impacts their business. For example, when supplier is deciding on the credit period to be offered to the company, they base the working capital of the company. For example, the company would use supplies bought on credit to manufacture the product and generate sales. So the revenue will then be used to pay the suppliers. So the suppliers, before deciding the credit period for payment, be it 30 days or 60 days or 90 days, will assess the company's working capital to see if they have financial resources to pay them. Similarly, companies can also have a negative working capital. For example, in case of seasonal business where their sales will be high only for a particular season, companies will stock up more inventory, they will hire more workers, which can lead to a negative working capital. But this does not sustain. Once their business starts to peak during that season, they will be able to generate more sales and will be able to pay the current liabilities, so thus bringing down the negative working capital. So there may be some instances where companies will have a negative working capital, but companies should ensure that they maintain the negative capital only for a certain period of time. So the company should focus on balancing their working capital because it is needed for managing the day-to-day expenses of the company. Now that we've understood what working capital is, we will now be able to understand how changes in working capital asset is going to impact cash flow from operating activities. For example, let us consider that there is a decrease in debtors for the company compared to the previous period. So this means the company is able to collect cash from the customers, so which indicates that there is a cash inflow to the company. So this movement has to be added back to the cash flow from operating activities. On the other hand, if there is a decrease in creditors, it means that the company has paid amount to its suppliers or vendors. So thus this movement in creditors indicates a cash outflow to the company and has to be reduced from cash flow from operating activity. In the same way, company will analyze the various movements across working capital assets and adjust for the movements in the cash flow from operating activities. Thus, we can now summarize that cash flow from operating activity is net income adjusted for non-cash expenses and changes in working capital assets. The second category of cash flow statement is cash flow from investing activities, which will include cash inflows or outflows from investing activities such as purchase or sale of fixed assets or purchase and sale of investments or stocks. The last category is cash flow from financing activities, and this discloses how the business is financed or any changes in business equity or debt position. So cash received from sale of new shares or the value of cash received from banks and cash outflows in the form of dividend paid, which also includes proposed dividend of the previous year paid in the current year, will all be included in cash flow from financing activities. So the sum of all the three categories will give the cash and cash equivalent at the end of the period, which will be reflected as closing balance of cash and cash equivalents in the balance sheet. So now we've understood the cash flow cycle of the business and also how companies will prepare the cash flow statement and how cash flows are grouped into three major categories, namely cash flow from operating, investing and financing activities. But is cash flow statement better in accuracy as compared to the income statement? Why should cash flow statements be even prepared by the companies? Income statement is prepared on certain accounting principles such as accruals, prudence, materiality, consistency. We will discuss in details on these principles in the coming video. While income statement is prepared based on these principles, there are chances that sales will be over accrued and cost of sales may be deferred to show higher profits and asset may be written down to show a lower depreciation. Hence, we can conclude that income statement, when prepared on these accounting principles, is based on estimation and income is accrued when earned and not when it is actually received in cash. On the other hand, cash flow statement is prepared based on actual receipts and payments by eliminating non-cash items which are just pure estimates, and it also only considers the realized gain or loss on sale of asset based on the actual amount spent. So therefore, cash flow statement avoids estimation errors and it also does not consider any unrealized gain or loss. So it only considers the actual receipts or payments or the actual realized gain or loss. As previously mentioned, cash flow statement that we have discussed till now is the indirect method of presentation. It can also be prepared based on the direct method. Only the cash flow from operating activities will differ in computation under direct method in comparison to the indirect method. Under direct method, cash flow is computed based on actual receipts reduced by the payment to suppliers. However, in this method of calculating cash flow from operating activities, it is difficult for large companies who usually do not maintain transactional details of every single supplier and may also offer bulk discounts on large purchases. Also, when companies adopt the direct method of presentation, they have to reconcile cash flow from operating activities to the net income shown in the profit and loss account, which is effectively the reverse engineering process in indirect method where we compute from the net income reflected in the income statement to arrive at the cash flow from operating activities. So most of the companies prefer indirect method of presentation over direct method. So, we have discussed in detail the cash flow cycle of the manufacturing business and the preparation of cash flow statement with cash flow from operating, investing, and financing activities. The structure of cash flow cycle for any business will remain the same. However, the items or cash flows that has to be classified as operating, investing, or financing activity will vary from one sector to the other and from one company to the other depending upon the business in which they operate. So, a cash flow statement it will be generally used by the company to measure liquidity, to plan for the future, and identify idle cash if any. We hope this video gave you a deep insight of cash flow statement and will also help you understand financial statements better. Stay tuned to our channel Smart Roots and don't forget to subscribe to get more interesting videos in the field of accounting and finance.